Hello everybody, so this video is entitled Market Meltdown, Forever Red. This has been a running joke I've been making for the past few days, using of course this emoji here of a crazy person, and that crazy person is Mr. Market. Mr. Market is crazy. Mr. Market lately has been throwing deals at us once a week, and so it's the title of this video, Mad Deals Once a Week. So let's talk about what's going on and the complete nonsense, because this is complete nonsense. Of course, throughout the 2020s, how many deep red days have we had? I mean, too many to count. Too many to count. This volatility is insane. It's through the roof, and it is nothing like the volatility I used to love back between 2010 and 2020. If you are lucky to have invested in the 2010s, you definitely see a difference. How many dark gray to black swans have we had the past 6 years? How many? A lot, by the way, right? They talk about the Dow Jones index heading for the worst month since 2022. Well, you know, they have to pick kind of an index because don't forget, like the biggest meltdown in the history of the stock market was April 2025. So now they have to pick, right? They have to pick, because otherwise if you say worst day for the stock market since, you'd have to say, oh, since April 2025, right? Because hopefully we're not going to relive April 2025. Everything makes absolutely no sense. I have a special slide for AT&T in a second, which is up the most. I decided to use AT&T. I could have talked to you about Wells Fargo, who's also up nicely today. Of course, Wells Fargo, of course, very innovative company. A few cold hard truths about the channel, about the market. A few things I want to share. First of all, I want to be a fundamentals channel so much. I really want to talk about just fundamentals. But the truth is, the denominator is broken. The dollar is broken. This market is so correlated to the expectations of a money printer and whether it's going to be turned on sooner than not, right? Today, people were saying, oh, there's going to be a rate hike. Oh, inflation is going to go to 5%, etc., etc., etc. There's going to be a rate hike. And that's why, for some reason, people are like, okay, let's sell the future, let's sell disruption, let's sell everything that makes sense, and let's buy AT&T because AT&T has 240 million broadband and wireless subscribers, and that is never going to be disrupted whatsoever. The debt is super safe on AT&T, no problem. Company known for its debt, super safe, no problem. Nobody's ever going to cancel internet to use, I don't know, perhaps a satellite internet? No, nobody's going to do that. Company's safe. Go ahead. The market is doing that. Buying Verizon too, right? Makes so no sense. Absolutely no sense. It's very hard to be a disruptive stock investor when the market does not go through normal weighing period. You hear Warren Buffett, right? Over the long term, the stock market is a weighing machine. Well, guess what? The stock market has not been a weighing machine for now going into 6 years, roughly. Especially as we go through these crises, we are overdue for a period of weighing, a period where stocks actually get valued on their fundamentals again. And every time it seems like we're going to have that, we don't, because there's another crisis, there's enormous uncertainty. We haven't had a single such period of quietness, just quiet weighing the stocks, just quietly discussing the fundamentals. Ever since the events of early 2020, we've had crisis after crisis after crisis. Endless turmoil and turbulence trump fundamentals, unfortunately. Unless turmoil, endless turbulence means the market is going to have a very short horizon, and it's only going to look at what's the day, what's the news of the day, and not really going to look ahead. So, a few specific stocks to illustrate. The market has lost its senses short-term and long-term. Let me show you short-term first. Two examples of stocks I cover on the channel. Nebius, you may remember, a few days ago, made this video, $27 billion deal with Meta. That's literally Nebius' entire market cap in revenue that's going to flow through the next 5 years, starting in 2027. The stock was up very big. Well, you'll be pleased to know that officially, and I didn't take the intraday up and intraday down, but officially all of the gains since announcing the deal with Meta are gone. Those gains are gone. See, that's Mr. Market for you. Like, they literally have the biggest deal of their history, twice as big as anything they had gotten so far, yeah, they lost all of the gains. All of those gains were erased in a week. I could say the same thing about HIMS. HIMS, you may remember, we're hovering in $27 range, well, intraday. Of course, it closed a little lower. But anyways, the point is, HIMS, the bear thesis was obliterated. They partnered with Novo. There is no more lawsuit. And they had a congratulatory tweet from Macari at the FDA congratulating them. The bear thesis obliterated. Well, don't go back to the $16 HIMS that it was trading after earnings. Forget about what happened after earnings. Remember the big drama, right? It was a evening, I can't remember which evening, but the stock closed at like 21 and started falling a little more after hours. After Novo said they would sue and they launched the pill, the oral Wegovy pill. If you follow HIMS, you'll be familiar with when this whole madness happened. Well, aren't we just a mere $1 away from the peak bear when it comes to HIMS? Right? Not after the earnings, but before the earnings, the bear before the earnings. We're only $1 away from that level. Like, this makes absolutely no sense. All of the overhangs, all of the issues that the bears love to talk about, these issues gone. These issues gone. They partnered with the company. There's no more lawsuit, no more nothing. No more legal issues. Right? The stock is trading at $22, only $1 more than when we were at the peak of the bear. And by the way, during the first partnership, of course, in, was it May of 25, HIMS was a $50 stock, right? Throughout 2025, HIMS was a $50 stock. Now it's trading at 22. The market makes no sense short term. Absolutely 0 cents short term. And so you may tell me, well, it makes a lot of sense in the long term, right? Well, let's look at the long term. Let's go ahead and let's do it. And you'll see the problem. This has been a denominator issue since the events of 2020. We still need to get back to stable monetary policy. The big advantage of getting the rates to zero is not really the fact that money printers go burr, because it's the commercial banks who print the money. And the commercial banks print most of the money. The Fed doesn't really print the money as much as the commercial banks, right? It's a secondary lender of last resort. That's what the Fed does. No, the big advantage of the 2020s is that the rates were stable. They were essentially nothing. They were stable. We didn't have expectations of rates going up or down. We had stable rates. The big issue of the meltdown in stock that we've known for the first half of the 2020s was we're not thinking about raising rates. And then biggest rate hikes in the history of the Fed increase the rates 20-fold. And literally do the exact opposite as what you had told all of the market, the businesses, the companies that you would do. Right? And now keeping the rates high, we have uncertainty in the rates because the market is expecting the rates to move. When the rates eventually go back to zero or close to zero, and they absolutely will, there is no overway, no overchoice unless you want a depression. If you want a depression, let's keep the rates at 4%. Want a big time 5x 1929 depression? Let's keep the rates at 4 or 5%. Let's even raise the rates. But let's assume people don't want a depression, right? Let's assume they want just regular turmoil, but not huge turmoil of the 1920s. Let's assume that the rates have to go back to near zero, maybe 1%, something like that. Otherwise, companies are going to start falling like flies. They're going to start dying. States are going to start dying. Pensions are going to start dying. The government is going to be in deep trouble. The rates need to come down. Big advantage is when the rates come down, we'll have stable monetary policy, i.e. zero or close to zero. And when that is, because you can't make the rates negative, of course. You may remember in Europe also had the rates to zero for the longest time. They were even talking about taking them negative to boost the economy. You may remember these days, right? The beauty of these days was not the low rates. Rates are very low anyways, right? 6% for a mortgage, that's actually a sponsored rate. In the natural world, interest rates would be much higher than that, right? In the natural world, under a full Bitcoin standard, interest rates will probably be 20 or 30%. Anyways, the big advantage of zero is that it's stable. And when it's stable, you don't have to look at stock charts that roughly follow expectations of what monetary policy is going to do. Because if you look, 2021... euphoria, right? Powell tells us, we're not thinking about raising rates. Everybody IPOs, SPACs, etc. Okay. And then Powell tells us, oh, no, now the rates are really bad. And so all of the growth stocks super crash, like super crash. Okay. And then look, we've had, of course, April of 2020, Liberation Day, another pretty darn big crash. And now we have this one, which is another pretty darn big crash. But this one is actually so big because of the optimism that was in the market in September. There was such optimism in the market in September that this drop actually feels much more precipitous, because we remember the value of our portfolios 5 months ago. We don't remember the value of our portfolios in April, right? You get accustomed to the gains. But the point is, if we look at the long term, SoFi, for example, was throughout the 2021s, when we had stable monetary policy, i.e. zero or close to zero, SoFi was trading, between 15 and $20, right, for like a year and a half, right? Yeah, a year. Same Tesla. If you look at Tesla is like we're back in the mid 300s. Okay, well, guess what? We're back to the late 21, mid 22 levels. We're back to these levels. We're back to like the April levels now. Tesla had some idiosyncratic happenings. So you may remember, I think it was exactly here in the chart when Elon Musk bought Twitter. That was exactly here, and then the bears owned the stock. But it didn't change really much. Tesla was 360 in 2021. Tesla is 367 right now. And of course, that's not individual returns, because if you do it right, if you DCA, you will have much lower entry levels through the valley of despair. But for that, you gotta be a special investor. You have to be willing to buy through the valley of despair. You have to be willing to buy through the valley of despair. Some investors don't do that. I see it on this YouTube channel. People, send me messages like, "Oh, cover this stock, cover this stock, cover this stock." When I look at the stock, and I'm like, "Oh, it already ran 100%. So why am I gonna cover it? I'm not gonna cover something that just ran 100%, right? It'd be like I missed it." Anyways, that's my point. So you can see this chart's actually pretty uncanny, pretty similar. But look at Bitcoin. Bitcoin is also very scary in a way, very similar, same thing. 64,000. 2021, okay, I'm nitpicking kind of the top. It went a little higher, but barely. Like, let's say, I think it spent like something like 10 days above 60 or 15 days above 60,000, something like that. Yeah, we're back here. We're back in the 60K range. What's the only difference? 5 years. 5 years is the difference. 5 years have passed. We were trading in the $60,000 range 5 years ago. We're trading in the $60,000 range 5 years ago. Yeah, Bitcoin should be so much higher than that. There is a liquidity issue in the system. That's what took everything down. Is that liquidity in the system is the reason why now CNBC is calling XYZ index in recession. I think the Russell, they call it in a recession. Correction. Next week, if this continues, they're gonna call the Nasdaq in a correction too. Right? They're gonna say the Nasdaq's in a correction too. So anyways, the market is deeply broken because of a denominator. Look over long term. Look at all the stock, and it's correlated to the hopes or the lack of hopes regarding rate cuts. And the big advantage is when the rates eventually go back to zero, you can't cut lower than zero, or like 0.25 or 0.5. If you're at 0.5, you're essentially at zero. You can't really cut any lower than that, right? So rates will happen. Rates will go down. But will they? I mean, at this point, I don't know how long they are going to delay wash. They could delay wash into 2027. At this point, I would not have many hopes for a portfolio in the 2020s. To me, I'm investing for the 2030s. I want the 2030s to be a great decade when the market starts making sense. When some of these old world companies start going bankrupt because of disruption, when people start to understand, Tesla start to understand that certain innovations are very much real, right? As the old guard eventually retires, Wall Street is still controlled by the old guard, who has a sour taste of what happened in the 2000s, right? In the dot-com crash and scream bubble, etc. So this is going to be replaced by a new generation of investors, of which I think many of the viewers of the channel are part of, right? We are part of that. So our assets, this is no financial advice, of course, ever on this channel, but they're deeply discounted compared to where they should be. The key in this period is, and this applies to a lot of crypto folks, right? Don't get wiped out. That would be one key. Or margin folks, don't get wiped out. That would be one key. Or options folks, right? Buy short options. Buying short options, it's a bad idea when one more tweet can make the turmoil last another month. Right? Options are a bad idea, I would argue. Short-term, long-term options is a totally different game. Totally more learned and wise to do long-term options. But short-term options, to me, they are a dangerous game. Or give up. Give up is the other risk. Right? The other risk is that some people are like, I'm tired. It's been 5 years like this. We have crisis after crisis after crisis. I just give up. That's the other issue. Right? That's another danger of not investing. That's another danger. I mean, I guess some people have like carpe diem philosophy and just enjoy life and not care. I guess in some states they have that view, but anyways, some countries. Gold. Let's talk about all of your things that are down today. Gold's down. So gold's not saving you. Now it's funny because whenever Bitcoin's down, we see headlines, oh, Bitcoin's not an inflation hedge. When gold down, we don't see these headlines. And of course, that's because gold is liked by TradFi. That's why we don't see these headlines. Bonds are down too. So I have no idea what market makers are doing. They're just sitting in cash, like in money market. If you're just sitting in, the money's just sitting at the bank. Oh my gosh, I don't know what's going on. And I guess if you wanted anything you could own to go up today, I mean, unless you owned AT&T, it didn't go up. Even bonds didn't go up. That's not how bonds are supposed to work. But mortgage rates are up. So if you're trying to sell a house, you're likely stuck in that house for another year, right? And they're up because of fears of a rate cut. Just in time for spring buying season, for home buying season. Mortgage rates going way above 6% now, spiking, relatively spiking. So anyways, as I titled the video like this, that was a few months ago, no, I will not buy AT&T. Let me double down on this. I will not buy AT&T. I'm not going to buy a company who's literally famous in the field of business for its debt load, right? A beautiful debt load for don't look up the Time Warner acquisition and the mess that this actually was and how much money was lost paying a pretty penny in 2015 and reselling it or spinning it off on the cheap. Anyways, complete, huge company, enormous company, but huge debt, huge debt. For what? For 240 million subscribers who have broadband and wireless. And I guess, if that's the way it always has been, so you can take a very long-term bond and you just use the subscriptions, of course, to repay your bond, right? Except here's the problem. Is internet going to be too cheap to meter at some point? And our cell phone minutes, they already are, but how cheap are they actually going to get? Right, and I would argue this sector I would want to stay away with 10-foot pole. I think they'll be heavily impacted by things like Starlink, direct to cell, or Amazon Leo. And I know what some of you will say, right? Some of you will say, oh, you don't understand. They will benefit from satellite to cell. They will partner. That will cover the rural areas. Yeah, that's what Netflix and Time Warner used to believe, right? Netflix, to become compelling, they partnered with Warner Brothers back in the day. And they had Big Bang Theory, they had Game of Thrones, they had all the shows. But give it a few years and they canceled the partnership. And I think that's exactly what's going to happen. Yeah, perhaps Leo and SpaceX, to have full coverage at first, they will partner. But at one point, they'll stop partnering. At one point, the partner will go sour. And to me, companies in the telco business are at a huge risk of disruption. Absolutely a huge risk of disruption. But never mind, that's what's up today. But that's okay. Wells Fargo is up too. So I guess bank branches are totally fine. No disruption coming. This market is absolutely crazy. That's all I have to say. I am going on my seemingly evening walk in the forest now. Anyways, This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you are entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day and weekend.